Choosing the right investment tools and resources does not have to cost money, yet most investors behave as if the best tools are always the most expensive. In reality, many of the most powerful resources available today are free. They simply require discernment to use effectively. The real advantage does not come from having access to something costly, but from knowing which tools genuinely improve decision-making, reduce noise, and support disciplined behavior over the long term. Free tools deserve attention precisely because they remove the excuse of, "I can't afford insight," and force the question back on process. How do you learn, analyze, and act with clarity? The first category of free resources that every investor should master is market data and price information. At a minimum, a reliable platform that provides up-to-date prices for stocks, bonds, indices, and major ETFs is indispensable. These platforms also often include basic charting historical performance and volume data that help you understand how an asset has behaved across different market conditions. What matters most in these tools is not the bells and whistles, but accuracy and latency. Delayed or incorrect prices can mislead decisions, especially in volatile environments. A simple, clean interface that lets you track multiple assets in one place builds situational awareness without distraction. Closely related is corporate and fundamental data. Many free financial information sites provide earnings, histories, company filings, balance sheet summaries, and key ratios. Understanding fundamentals keeps investment decisions grounded in economic reality rather than headlines or speculation. Instead of relying on catchy narratives, investors who use these resources can compare valuation metrics, analyze revenue trends, and assess debt levels without paying for premium subscriptions. This level of analysis is sufficient for most long-term decisions, especially if combined with a disciplined framework for screening opportunities. Another essential category is economic and policy data. Government agencies, central banks, and international organizations publish inflation figures, employment statistics, GDP, growth interest rate announcements, and other macroeconomic indicators at no cost. These data sets are primary sources rather than filtered summaries. Investors who learn to interpret them directly, rather than through media headlines, gain a clearer understanding of the forces shaping markets. Raw economic data equips you to ask deeper questions and avoid reacting to noise that has little lasting impact. Free educational content is ubiquitous, but not all of it is equally valuable. Quality comes from sources that prioritize clarity over sensationalism and depth over brevity. Many universities, regulators, and established financial institutions offer foundational courses on investing, principles, risk management, behavioral biases, and market structure at no cost. These courses do not promise quick profits or insider secrets. What they do offer is context that helps you understand why markets behave as they do and how different instruments work. Building intuition through structured learning is one of the most cost-effective investments you can make. Then there are community and discussion platforms where investors share ideas, questions, and experiences. These communities are free to join and often contain thoughtful analysis that challenges your assumptions. The value here is not in copying opinions, but in exposure to diverse perspectives that force you to refine your own reasoning. Wise participation means asking questions, testing ideas against evidence, and resisting the urge to adopt consensus as truth. Not all crowdsourced content is good content, but the observer who filters carefully can learn faster than someone who learns alone. Many brokerages also provide free research tools, including analyst estimates, sector comparisons, and portfolio tracking. While proprietary research should be taken with a grain of salt, the ability to see consensus forecasts or risk metrics adds another layer of information. Combined with your own analysis, these tools create a more complete picture than any single source alone. The key is not to accept them uncritically, but to use them as input in a broader analytical process. Another category that is often overlooked is tax and retirement planners offered free by government agencies or reputable organizations. Knowing how capital gains taxes, retirement contribution limits, and tax-advantaged accounts work can dramatically affect net returns. Strategizing around tax efficiency does not require expensive software. It requires understanding the rules and having a tool that helps you simulate different scenarios. What unites all of these free tools is that they shift the investor's focus from short-term price speculation to long-term understanding. Price data grounds you in reality. Fundamental and economic data provide context. Educational content deepens judgment. Community engagement tests assumptions. Research tools expand perspective. Tax planners protect what you earn. Used together within a disciplined framework, these tools strengthen decision-making without draining capital on subscriptions that offer diminishing returns. However, free does not mean effortless or automatic. Tools are only as useful as the framework in which they are applied. An investor who lacks process will be overwhelmed by information, just as a carpenter with a full workshop, but no plan will produce poor results. The real question is not which tools are free, but how they fit into a consistent process that moves you toward clearly defined goals without emotion overriding judgment. Because knowing what to focus on and what to ignore is what separates thoughtful investors from reactive ones. And that is exactly where we need to go next, by examining how to actually use free investment tools without drowning in information. Because abundance without structure quickly turns advantage into distraction. The first step is deciding what each tool is allowed to do in your process, and just as importantly, what it is not allowed to do. Market price platforms are for awareness, not for triggering impulsive trades. Fundamental data sites are for validating long-term assumptions, not for finding excuses to overreact to quarterly noise. Economic data sources are for understanding direction and pressure, not for predicting exact turning points. When tools are assigned clear roles, they stop competing for your attention and start supporting judgment. The second step is limiting inputs deliberately. More data does not equal better decisions. Free tools tempt investors to check everything all the time. Smart investors choose a small, consistent set of sources and ignore the rest. Consistency builds pattern recognition. Jumping between platforms creates confusion and false urgency. If a piece of information is truly important, it will appear across multiple channels over time. If it only appears once loudly, it is usually noise. Another critical discipline is separating learning time from decision time. Free educational content is invaluable, but it should not be consumed in the same mental space where investment decisions are made. Learning expands understanding. Decision-making requires restraint. Mixing the two often leads to overconfidence, where new concepts are applied prematurely without experience. Investors who learn continuously but act selectively tend to compound both knowledge and capital more effectively. Free tools also require skepticism. Analyst estimates, community opinions, and consensus forecasts are not facts. They are aggregates of beliefs. Their value lies in showing what is already expected, not what will happen. Treating consensus as confirmation rather than context is a common mistake. The goal is not to agree or disagree reflexively, but to understand where expectations are concentrated and where surprise might matter. Portfolio tracking tools deserve special mention. They are useful for monitoring allocation risk and drift, but harmful when checked compulsively. Constant monitoring increases emotional volatility without improving outcomes. Setting a review schedule monthly or quarterly restores balance. The portfolio should serve your life, not demand your constant attention. Tax and planning tools are most effective when used proactively, not reactively. Running scenarios before making changes highlights second-order effects that are easy to miss. Many investors focus on gross returns and ignore net outcomes. Free planning tools quietly protect long-term results by revealing trade-offs that excitement obscures. The biggest mistake with free tools is outsourcing thinking to them. Screen scores and indicators can inform decisions, but they cannot make them. When an investor begins to feel that the tools are deciding, it is time to step back. Tools should sharpen questions, not replace them. In the end, the best free investment tools and resources are not a substitute for discipline. They are a test of it. They reward clarity, patience, and intentional use. Investors who master them gain a durable edge, not because they know more, but because they react less. That restraint practiced consistently is often more valuable than any paid subscription. If this discussion helped you rethink how you use free investment tools, consider subscribing to stay with these long-form conversations focused on process over hype, and leave a comment sharing which tools you plan to simplify or stop using, because removing distraction is often the fastest way to improve results.